The views expressed on the following program do not necessarily reflect the views of Money Radio 1510, staff, management, or advertisers, and do not represent an offer to buy or sell any securities. This is Hard Money Watch with Pat Gorman on Money Radio 1510.
Good morning. This is Pat Gorman's Hard Money Watch. I'm Sinclair No. Today is Sunday, December 9th, 2012. Pleasure to welcome Jay Taylor. He is the editor of Jay Taylor's Gold and Technology Stocks and Jay Taylor's Energy and Energy Tech Stocks. His interest in gold's role in monetary history led him to research gold and analyzing and investing in junior gold shares. He's a frequent speaker at investment conferences and various radio programs. He's been, pretty much across the board. You've probably seen him somewhere. And he's worked as a bank credit analyst, lending officer, investment banker with many multinational banks in New York. Along with the publishing of his newsletter, he also hosts the web-based radio show, Turning Hard Times into Good Times. And for more information on the radio program, the newsletter, the daily blog, the best site is probably to visit jtaylormedia.com. That's J Taylor Media, spell it out, Jaytaylor media.com. Jay, good morning. Thank you for joining us.
Oh, good morning, Sinclair. Good to be with you.
Hope you're doing well.
Doing okay. Surviving in a very difficult market, but there's so many uncertainties these days, Sinclair. I think certainly in the political realm, we were hoping we'd get some resolution from the presidential elections, but it seems as though the nation is as divided as ever, and there's a lot of polarity. I think there's sort of two basic different philosophies that are fighting with each other. I would say, in general, the notion that we should be able to keep some of the income that we make, the profits. So the idea of private property and the right to keep that, as opposed to more of a socialist or communist mentality that suggests that, the people that don't have much, it wouldn't be their fault. It has to do with their, that they weren't dealt the same advantages as other people, and so therefore we should take from those people that that do have the advantages and give to those that don't have the advantages. And I suppose that, there's always some truth to that. Some people are born with silver spoons in their mouths, and other people are born in ghettos and so forth. But, if we want to take away and penalize success, I'm not sure that that's the best way to go. But I think those are the two major things that are causing us so much consternation in this country right now, is this basic philosophical difference about what government should or shouldn't do, and until we get that resolved, I think life is quite complicated for those that stop long enough to think about it. I think a lot of bread and circus in this country. We can keep watching television, we can watch our favorite sports teams and tune out the things that really matter in life, or we can start to focus on some of the important issues and try to plan our lives accordingly. And that's, of course, what I try to do in my newsletter and on my radio show.
Do you not think that there was some resolution brought about by the elections?
I don't see any. I mean, I honestly don't see any, and nor did I expect any, really. Sinclair, did you?
Well, the elections were decided.
Yeah, what did they decide?
They decided to keep going with 4 more years of Obama.
Yeah, and a Congress that's pretty much the same, and that's what I mean. I think that the Congress is basically, reflects, but, the problem, the disconnect also, as far as I'm concerned, is that the Congress doesn't really reflect the people. It reflects the lobbyists. In actuality, its policies and what laws are passed are a result of the lobbyists, and the people are disconnected from, I think, to a great extent, from the Congress at least, and it's demagoguery and rhetoric that wins elections. It's perception is reality in politics, and I think it's all about millions and millions of billions of dollars, perhaps now, spent on elections, basically in packaging and imaging people rather than So as long as Mr. Obama has as long as he's perceived to be caring for the masses, and he gets more votes. And I think that then if you look and see what he actually does, may not be the same. But no, I don't think too much was accomplished, and except more water over the dam, more time gone, and more debt piling on top of debt. And I look at the debt relative to GDP, and I say we are really in a bad shape here. We're really in a situation where, for all practical purposes, the nation is bankrupt. And then you look at old guys like me. I mean, I just now entered my retirement years, and I'm one of the older baby boomers. So there's an avalanche of claims against the government for which there is no money to be paid, no resources to finance that. Somebody was saying today, $85 trillion in present value on top of the debt that the government already has. And there's just, it's just not I'm sorry to be so doomsday, but I don't see the answers right here, Sinclair. I'm sure there will be an answer. I'm sure we're going to come out the other side. Richard Mayberry has some really optimistic views. I was reading his latest newsletter, and Richard is, believing that you're seeing the progress that's made by Ron Paul and others, but his view is, and Bob Hoy and others, is that basically the guys are going to do themselves in with their bad policies, and essentially, the people will run them out of town, run the policymakers out of Dodge, and then there will be an opportunity for free markets to re-enter the picture. And I hope that's right. I think that's what we have to hope for and work towards.
You mentioned uncertainty in the marketplace. Are you starting to see that, though, reflected in specific markets? So far, it doesn't look like it's had a particularly negative effect on the stock market.
No, I would say on the equity markets that's true, especially among the bigger cap stocks, I think, although, I guess somebody was saying that Apple is entering bear territory now, and that's a pretty devastating thing for them.
And you could narrow down the S&P 500 to probably about 10 companies that have been performing well.
Yeah. So I think that the vast majority of companies and people, I think the people that have sophisticated trading programs, logarithms that run well to trade and to pick people's pockets, I think they're probably doing all right. I came across a company that I think is very, very interesting, a limited partnership that Goldman Sachs just took from a regular, it's in the it's in the vertically integrated refining and distribution of petroleum products out of Texas that is offering something like a 26% yield based on the company's guidance right now. And Goldman Sachs, I'm sure, is making a huge amount of money on that. And it's a very interesting story. I'm recommending it to my subscribers this weekend, and bought some for myself. But so there are people, I think, in the financial markets that are making huge amounts of money. We've gotten away from the people that actually produce the products that are worthwhile being richly rewarded, and to the people that sort of engineer these products as the ones that make a lot of money. And I'm talking as an ex-banker who used to work with ING Bearings. We did some of that. I know how the game is played, and all the derivatives products and so forth. So there are people that are doing extremely well, and there are certain markets that are doing very well. But if you look, the average investor is getting out of the market, from what I understand. Most people are saying, this is too risky. I'm risk averse. And what I'm seeing also in the area that I'm more involved with, in the junior mining sector, is that we are looking at one of the toughest environments for the speculative exploration companies that I've seen since I started in 1981, and there have been some really tough times during that, the 20-year bear market in gold and stuff when I started writing my newsletter in 1981. So, but I'm just looking at, I think what's happening, Sinclair, is that we're in a credit deleveraging, I think the early days of a credit deleveraging process. And with that being the case, then I think what we're seeing is, a lack of risk, willingness to take on risk for the more speculative kinds of investments. And so that's meaning that people are really looking for quality right now.
If we see some more credit deleveraging, that would mean continued deflation, and that would allow more of the what you would anticipate would be inflationary from the Fed. You would anticipate that all this money printing that they've been doing would have an inflationary impact, but if we continue to see credit deflation, then it sounds as if we're probably going to see more of the Fed over the next couple of years, probably.
Yeah, I think that's right, but I would also say that we might get to credit deleveraging through a process of inflation as well. And what I mean by that is that, is that everything, asset prices are inflated, and probably salaries, although salaries, this is a real big problem in America because wages are not going up and they're not keeping up. I think that's one of the drags against inflation, actually. It's squeezing the middle class. But in theory at least, what we could have a deleveraging process where debt becomes less relative to income just simply because income has become, hyperinflated. And then one way or another, I'm convinced that we're going to see a major deleveraging. If you go and look at the numbers right now, we're looking at something like, it's like 360% of GDP if you take all debt, not just government debt, but private sector debt, every aspect of private and public sector debt in the United States. And the previous high was something like 260% at the very depths of the Great Depression. And that ratio went up because income fell off the table. I mean, it's just a plunge in during the Great Depression, a plunge in income. We haven't seen anything like that plunge in income, but we've seen that ratio rise 100 points of the previous high. And typically that ratio had been between 125 and 225%, but it got to 260 in the Great Depression, which was an anomaly, and now we've taken it up to as high as 380. We've seen a tiny little curl over, a tiny little reduction in the ratio of debt to GDP, almost all entirely coming out of the private sector because government has really picked up the slack mostly. But we have seen a cessation of the increase in the debt to GDP ratio, but it's a tiny little curl over that's just very, very small compared to income. And income is growing, but very, very, very slowly, 1%, 2%, whatever, and debt has just grown exponentially. So I think that we are basically broke. I think the country is bankrupt now. I think that I just think that there are people, there are the parasitic element of our society, the bankers and the governments, the people that live off of the actual income-producing organisms, but the parasites are growing much more rapidly than the economy is growing, and ultimately, you see them. Your supply of goods and services are shrinking, and the parasites are getting fatter and fatter. So I guess if you can be amoral about the whole thing, you become a parasite, and in order to survive, and you suck the blood out of the living organism. But but in a way, when I sit here next to my screen and I'm looking at ways to try to make a few trading profits, I'm joining in the game, I guess, in a way. Would love much more like to be able to look at investments, work real hard, and find something you can buy and hold simply on the basis of the strength of the investment and the company, the underlying asset, and the cash flows. But it just seems like you almost have to get involved in this trading frenzy that's going on to try to survive.
I think there's a difference between being involved in services and being involved in the parasitic side of finance. The parasitic side deals more, I believe, with the interest and debt portion of it rather than the services side of finance. And hang on to that thought. I'll continue to address that, and we'll talk about it a little bit more as we continue with Jay Taylor. Jay Taylor from jtaylormedia.com, Jay, spell it out, jtaylormedia.com. And you might also want to tune into the web-based radio show, Turning Hard Times into Good Times. Turning Hard Times into Good Times, We'll have some more good times with Jay Taylor in just a moment. Money Radio, our guest, Jay Taylor. Jay Taylor from jtaylormedia.com. Spell it out, Jaytaylor, jtaylormedia.com. Jay is the editor of Jay Taylor's Gold and Technology Stocks and Jay Taylor's Energy and Energy Tech Stocks. And at some point here, I want to get into the idea of what's going on with some of the mining stocks as well. But earlier this week, Jay, we saw a couple of reports that I thought were very interesting. One was the jobs report this past Friday, which showed manufacturing drying up, but services the only area of any strength whatsoever, and that's a real broad category when you talk about services. Likewise, the ISM report on manufacturing and services sectors showed the same thing. And then we had the flow of funds report from the Federal Reserve indicating that Americans as a whole are cutting back on mortgage debt. Part of that is taking advantage of the lower rates. Part of it's that they continue to lose homes in foreclosure, but they continue to build debt, consumer debt, student loan debt, car loan debt, a couple of big areas that are continuing to push up the overall debt. Mm-hmm. And if you look at where the parasitic side of this comes in, somewhere in the neighborhood of 40% of everything goes to interest payments these days.
Ah, wow. That is incredible when you think about, Sinclair, how low the interest rates are. But I guess, if you're talking about consumer credit, and now you are, I think, really explaining the parasitic, the use of the word parasite when you look at that, because banks are getting money for next to nothing, and they are charging, I don't know what they're charging on credit cards. I mean, I'm fortunate enough to keep mine paid off. We use it for a monthly cycle to pay bills and things, and I don't really know what, but there must be some huge interest rates then charged.
But it's debt upon debt upon debt.
Oh yeah, the compounding, the compounding of debt. Sure, mm-hmm. Sure. Yeah, I mean, if you look at the federal debt, for example, it's we're getting paid next to nothing for lending money to the federal government, which is broke. I guess because the theory is that they can continue to pay us back with printing press money, and that's true until people don't accept the money, and then it's worthless. But the power of compounding, of course, is something most people don't focus on or understand, but it is really very significant. Now, if we start to get interest rate rises, which you would think most certainly would be coming at us at some time in the future, if people lose confidence in the dollar, then it could really feed on itself. This whole insolvency situation, I think, is already baked in the cake, unfortunately.
Unfortunately, I keep looking for a way as to how the Federal Reserve is going to get out of all of this quantitative easing, and I don't really see it except for more quantitative easing. We may be looking at another round of QE.
Yeah, I'm afraid that's the case, and it seems to be the only thing that they know to do. Of course, the only real solution would be for government to take its cotton-picking hands off. The problem is the longer it continues to intervene in the economy, government and the Fed, the more pathological the system becomes, the more out of kilter with its equilibrium it is, and the worse it is, so that the pain that would be suffered when the system breaks down is all the greater. And that's the problem, of course. The Austrian economists maintain that there would be no business cycle were it not for government. The government gets involved and starts creating malinvestment, and it's the government and the central bank intervention in the markets that leads to malinvestment, doesn't allow the continuous correction of markets that start to get out of kilter. So, if you allow, for example, banks, for example, to keep making bad loans, and you encourage them to do so, or you allow and encourage consumers as soon as they pay down 10% of their credit card line to go back and borrow the other 10% again. I mean, to me, that's what's happening now, is that consumers are broke, and so they pay a little bit of their debt back, and then they go out and have a good time again. Go out, go out to eat, go out and I don't know what they do. People go out and just enjoy life a little bit. Nothing wrong with that. The problem is that we've been enjoying life beyond our capability to enjoy it, and we've leveraged the future, and the future is now. That's the problem. And I mean, look at the
and Jay, hang on. Right now, we actually have a news break. We'll take that news break. The clock is coming up here, and then we'll continue our conversation with Jay Taylor from jtaylormedia.com. jtaylormedia.com. You're listening to Hard Money Watch on Money Radio. We're back with more Hard Money Watch. This is Pat Gorman's Hard Money Watch, of course, and I want to take a moment to tell you about a little bit about the history of this program. It was started some 22 years ago, I think it was now, by Pat Gorman. And Pat Gorman, a lot of you know. Pat and Linda Gorman run Resource Consultants over in Tempe. They are a precious metals broker, and they can assist with all of your precious metals needs. Physical delivery of gold, silver, platinum, palladium, coins, bullion. They can help you arrange to hold physical metals in your IRA. You'll find that they're extremely competitive in their pricing and just a great company to do business with. Pat and Linda Gorman, Resource Consultants. Give them a call. And if you have questions about anything related to precious metals, I'm sure they can find the answer for you. 480-820-5877. 480-820-5877. And be sure to visit the website, buysilvernow.com. Buysilvernow.com. The Gormans have always believed in education. They've always felt that if you understood the situation and were an educated investor, you'd make a good decision, and they would hope that one of those good decisions would be doing business with them for at least part of your portfolio where it comes to precious metals. Towards the end of education, one of the things they've done is over the past, well, I guess it's 15 years now, they've presented the Wealth Protection Conference in the springtime in Tempe. And I started going to those conferences years ago and started participating in them, and that's how I got to meet Jay Taylor. He was one of the featured speakers at the conference. And over the years, Jay and I have had some really great conversations. And we started out this first half hour with a good conversation, Jay. It's good to talk to you again.
Well, thank you. It's good to be with you as well.
Wanted to kind of switch the focus over to gold, and maybe we can even look at some of the gold miners. But let's start with a look at the metal itself, because there's been some interesting activity. Just in this past week, we saw gold spot prices drop down around $16.85 in the middle of the week, then bounce back up a little bit off of that. In euro terms, I think that gold dropped down around just under 1,300 euro per ounce, per troy ounce, which is at about a 4 to 5 month low. And there are a lot of things going on, ETFs and some new trading over in Shanghai as well. What can you tell us about what you're seeing in gold prices these days?
Well, I don't follow gold. I don't trade gold like a lot of people do. I'm a long-term gold bull. I'm not as bullish on gold for the moment as some people are, because it seems to me that we are not having the kind of money, say monetary stimulus that we had been having. And so I think one analogy that I heard in a speech last week was that what we've got is this huge debt problem. And he showed a slide talking in terms of the kitchen sink and, the faucet running water into the kitchen sink. And what they're doing now is more or less just keeping enough water going into the kitchen sink so that as it leaves, it retains its same level. And that's kind of what I think is. I think if we get another real monetary stimulus, we could see gold take off really rapidly. And the other thing is, I think that we could see gold rise if there was a financial crisis. And again, I always talk about the real price of gold rather than the nominal price of gold. And here, I think the gold picture is looking much better than people realize, and I'm not talking day to day as much as the post-Lehman Brothers trend, which has really been on an uptrend. I talk about this almost every time you and I get together. I think it's what an ounce of gold will buy since Lehman Brothers went down. It's gone from 17% of the Rogers Raw Materials Fund to as high as 49.5%. When I looked yesterday, it was about 45.5%. But the point is, from 17% to 45, 50%, close to 50%, an ounce of gold, it's become much more precious in terms of oil and copper and food and clothing items than it was before this credit deleveraging process got underway. Sinclair, if it's all about confidence. It's about confidence in the monetary system. Now, you and I are gold bugs. I think you don't mind me saying that about you.
No, I'm a gold bug.
I'm a gold. I believe in real money. I believe that what the government forces us to use, over the barrel of a gun, is fraudulent money. It's money that allows the government and the other parasites to take wealth away from the people that actually create it. And I think that when one day the world is going to wake up, and I think the Chinese and others are much more skeptical about their governments, much less trustful. But here, we have all of these PhDs from Yale and Princeton and Harvard, and we've got Oxford people showing up occasionally, and Cambridge people, and all these wonderful intellectuals that are really the most dangerous people of all, in my view, because they look so respectable, and yet they are the thieves. They are the people that are behind the Federal Reserve. They are the intellectuals that make most of us believe that, well, gosh, I don't have a PhD from Princeton. This guy's got to be smarter than I am. And look how smart he is with mathematics and how he can figure out, what interest rates should be or what any kind of other regulation. Well, of course, that's the fallacy. But if people lose confidence in these characters that have been allowed to run our lives rather than allow us to be free and make decisions spontaneously in the market, one day, and I fear it's not very far away, there's going to be a tremendous loss of confidence in Caesar, in Obama, in whoever's running our lives. And I think this is part of what makes Richard Maybury so positive about, his optimism comes from this notion that these guys are really messing things up so badly. As Bob Hoy says, he's convinced we're very near a bull market in common sense. That in fact, so when that day comes, gold could go to levels that are unbelievably high because people will trade in their paper, which is the confidence by the con men, and for real money. I had John Butler on my show. He's written a book. He's a British analyst. He's written a book on gold and the markets now, and he's convinced that in the very near future, within a couple of years, we're going to see a return to an international gold-backed standard that would be at least akin to what we had in 1971, before Nixon closed the window. And the reason will not because the United States would want to, but because the creditor nations will require it. And I think you can sort of see it coming with the Chinese and other banks, nationally, Russia and other countries, accumulating lots of gold. I think something's up. I think it's going to happen. And so at some point in time, when confidence is lost, I think we could see the price of gold rise, and silver, by the way. Maybe silver is even more bullish. A lot of people think it is. That we'll see both of those metals, those monetary metals. They're monetary metals because they've nature gave them the properties that make them appropriate for barter trading and store of value until you need to take your value and use it. And when we see that happen, I have no idea where gold can go, but Butler believes that as a practical matter, to make an international trading system doable, we need to see at least $10,000 gold. To me, and to most people that don't understand the pathology of our monetary system, to most people that sounds ludicrous. But to those of us who realize that this thing is just a house of cards, that the government is one big Bernie Madoff personified, that we're going to see a day when the price of gold goes to levels that I have no idea. Nobody knows where it's going to go. It depends how much loss of confidence, if there's any confidence left at all in paper money, it remains to be seen. And that is really going to govern. You know, people sometimes say, well, we've got more mine supply, less mine supply. Mine supply has almost nothing to do with the price of gold. And it's very difficult. Mine supply has been very constant, a couple of percent a year, 1 or 2% a year, something like that. But what really makes the difference is confidence in the monetary system or not. And so what we've seen is gold going up in real terms, which has bolstered mining company profits. The big guys are doing very, very well right now. The big mining companies, the Newmonts, the Goldcorp, the Barricks, the Agnico Eagles, those IM Gold, those companies are doing very well. And they're doing very well because the real price of gold is going up. So the product they're selling is going up. This year has been a little bit of a pullback, but since Lehman Brothers, it's almost tripled in terms of the earnings of these major companies, and so I think we're in the bull market of a lifetime for gold mining companies, and probably the same can be said of silver mining companies. But at the same time, it's also a very, very risky time for the more junior exploration companies in this space.
I think one of the things we're seeing, and perhaps we saw a little bit of it with the price action this past week, is that the paper side of the metals market is coming under some attack. Mm-hmm. Physical demand continues to grow from individual investors. We've also seen an increase over in the Far East. We just saw Shanghai opening up a new exchange this past week or so, I think it was. Mm-hmm. Meanwhile, you've got the futures markets, and I don't know that there's an ounce of gold behind most of those futures contracts.
Yeah.
And then you've got the ETFs as well, GLD, SLV, and so forth.
Yeah.
And at some point or another, you talk about confidence, and I think there may be a challenge to the confidence of these paper metals markets, and people may start to demand actual
delivery.
Physical gold. Yeah.
Yeah, and if that's true, I mean, I think that's, again, that just gets to the confidence issue, you know. If they lose confidence in the financial markets, and I mean, if people really believed what you're saying, and I do believe what you're saying about some of these ETFs being suspect, and because in the prospectus of some of these things, it doesn't say they have to hold physically ounce for ounce. So they could be playing paper games, and you know, if that's true, then I think you know it's just hard to say because there's so much more paper out there. If everybody wanted to take delivery, it just wouldn't be there. Most people just roll that paper over, you know, and to the next contract period, or they, you know, or they just, you know, cancel out between the buyers and the sellers, and they go away. But if people really decided, those on the long side decided that they really wanted to take delivery, I mean, it could be really some sight to behold.
Now, over to the gold miners specifically, you talked about some of the bigger gold miners. Is that where you would look? Do you look at the GDX, even though it's been a little bit negative lately? Does that concern you, or are you looking somewhere else?
Well, I look at individual stocks, of course, in my newsletter, and I'm not that bullish on the really big guys, some of them that I named. I track those guys. I don't have them as recommendations in my newsletter. I track the big names just to sort of keep track of how the big guys are doing, because my belief is that as they go, so will ultimately those companies down the food chain. So I think that the big guys, well, they're having a lot of trouble replacing their production. And, you know, the average grades that are being mined now are much, much lower than they used to be. And that means that the capital expenditures are much higher than they used to be. So it's getting more and more difficult for smaller mining companies to come up with the capital that's required to build mines. But the little guys are still better at finding the gold in the ground, and they then become the targets of the big guys. What I prefer is sort of the next level down from the big guys, smaller companies that have great exploration potential and companies that so can grow on a percentage basis much more rapidly than the big guys can. And most of all, though, companies that are now in production or have cash flows that can sustain them, because what we're seeing among the junior mining companies in Canada, and they're mostly Canadian companies, is a huge problem. These companies, I think I saw. I'm looking for some statistics now, but from memory, the other day I came across some information that said 62% of the Canadian companies were selling at under 20 cents a share and had less than $2 million of working capital. And 41%, I believe was the number, was selling under 10 cents a share and had negative, just almost no working capital at all. So these are companies that can't go out and raise capital. They can't go out and just to keep the lights on. They've got no cash flow. These are companies that during good times would be able to sell their stock at $1 or $2 a share and raise a few $1 million and put more holes in the ground and hope they find something. Right now, those companies can't do that because the dilution factor would just be too great. I mean, I'm seeing companies that would have sold at $2 and $3 a share a few years ago, before Lehman Brothers, that are now selling at 20 and 30 cents a share, or 10 and 20 cents a share. I've seen companies that when they come out with their preliminary economic assessments, the PEA may say that they're worth 10 times what the market cap is, and even when they come out with those numbers, the stock goes down. So I think we're in a position, and I think we're at a time when investors are just not able and not willing to take risk. And I have never seen it. We're almost as bad as we were right after Lehman Brothers in 2009 in the junior sector, among the lower level companies, among the companies that have to go out and raise capital constantly by selling shares for high risk exploration games. So what that means, though, is those companies that have been spending money picking up very valuable data, drill data, and geological information have value there. It's the only thing is you can't monetize. It's not being monetized. But that value is there. And the companies that I particularly like are the companies that have the cash flow that can grow and can go out and pick those little guys up. It's unfortunate for those companies and the shareholders, but this is the way life is. I mean, the big guys are the predators, not the biggest guys, but they will be too. But the guys, I think, the ones that have the chance to make shareholders most money are the ones that have good cash flows that can go out and scoop up these other junior exploration companies that are on death's door.
And I'll follow up on that point in just a moment. We'll take a quick break. We're talking with Jay Taylor. Jay Taylor is the host of Turning Hard Times into Good Times. It's a web-based radio show. You can find out more about that at jtaylormedia.com. jtaylormedia.com, and spell that out, JAYTAYLOR media.com. And you can also find out more information there about his newsletters, Jay Taylor's Gold and Technology Stocks and Jay Taylor's Energy and Energy Tech Stocks. Our guest, Jay Taylor. This is Pat Gorman's Hard Money Watch. More in just a moment. Our guest is Jay Taylor, and this is Hard Money Watch, Pat Gorman's Hard Money Watch. I'm Sinclair No. And we've been talking a little bit about some of the mining stocks and the possibility of some acquisitions taking place, Jay. We saw a big one this past week from Freeport-McMoRan, but it really didn't deal with picking up some of the smaller miners, more so picking up space in oil and nat gas exploration. I think it was Plains exploration and part of McMoRan exploration that they picked up, but it was about a $20 billion deal.
Yeah. I don't know the logic of that. I'm not quite sure that I understand that. Of course, Freeport-McMoRan had a history, I believe, earlier on as an energy company. I think that just trying to look at just looking at the chart here, I think the market didn't like it too much. Actually, They took the shares down quite a bit from around $40 to, I don't know, 32 or something like that.
And I would say one of the reasons for that is that J.P. Morgan Chase was financing a large part of this deal, and you know who's going to get the best end out of all that. It's not going to be...
It's not the producers of real things that make our lives better. It's the guys that manipulate the producers. So,
you got that.
Yeah, that's the banksters, as they're known. So I see that it's down quite a bit. Well, Freeport-McMoRan, I think, is a fabulous company, no doubt about it. And I guess it remains to be seen whether this is a good deal or not. But I think that you're going to see, you mentioned Freeport-McMoRan, which really leads me to an interesting kind of company that I really like in the resource space, and that is companies called project generators. And what made me think of it is there's a company called Eurasian Minerals that has they're a project generator that has a pretty good chunk, I think it's around 36%, of an exploration project in eastern Russia that Freeport-McMoRan is involved with. And this is the largest copper-gold undeveloped resource in the world. And basically what happened, Eurasian was able to come in with $4 million and bail out another junior that didn't have enough money to stay in the joint venture with Freeport-McMoRan. So for a small amount of money for Eurasian, and Eurasian is a company with, I think, $60, $70, $80 million on its balance sheet and cash flow coming in the door as well, they were able to get a nice big piece of this exploration project. But Freeport-McMoRan is a fabulous company, and I think they'll be probably looking for other projects. I just don't know, be interested in knowing more about. I haven't had time to read yet or hear what management's logic is for energy, but maybe they see that as a hedge. You know, one of the things that these big mining companies and Freeport-McMoRan moves huge amounts of rock to pull out copper and gold from their projects. Maybe they see owning oil as and other energy sources as a hedge against possible inflation. You know.
Yeah, and production costs down the road.
Possibly.
I'll leave us with, and we got about a minute or so here. I'll leave us with this thought I saw from Eric Sprott, who is, very influential in silver in particular.
Yes.
I saw a quote from him this week that said, "There is no doubt that central planners are trying to avoid a financial collapse here." Mm-hmm. Do you think that that's really the case, and do you think we're really getting close to it?
I'm afraid he's right about that. I wish it weren't so, but I think he's right about that. And Eric certainly has put his money where his mouth is. He is a big investor in silver, and in fact, I'm looking at PSLV is his silver silver ETF. I think it's a legitimate one. You know, it's one that I believe the silver is actually there. And Eric has made this point that there could be a squeeze on the paper market that could really cause silver to go berserk. I think he's looking at $100 silver somewhere in the not too distant future. Mm-hmm. So that's very possible. I think it could even exceed that. No one knows for sure.
I wouldn't be surprised. Jay Taylor, Jay Taylor's Gold and Technology Stocks, Jay Taylor's Energy and Energy Tech Stocks, and Jay Taylor's radio program on the web, Turning Hard Times into Good Times. To find out more about everything, go to jtaylormedia.com, jtaylormedia.com, and spell it out, J-A-Y, jtaylormedia.com. I'd like to thank our host, and that would be Pat and Linda Gorman from Resource Consultants. They've been bringing you Hard Money Watch for more than 20 years now, and if you'd like to find out more about what they do, and they really should be your precious metals broker, give a call, 480-820-5877, 480-820-5877, and their website is buysilvernow.com. Jay Taylor, always a pleasure, sir. Thank you so much for joining us.
Oh, thank you for having me.